Hello, it's Mark from Landmark Financial Services Group. This is our second video in a series of tax planning videos that we're doing. This one is about what we call a Roth conversion, Now, this is ultimately based on the fact that the stock market is down year to date, okay? Which means that assets in your retirement accounts have come down. Now, obviously we don't want to see our portfolios down, but when they are, we start thinking about opportunities that might exist, and a Roth conversion is one of them. So let me explain what that's all about. This is a retirement account, and most of the time you have two different retirement accounts, a traditional IRA and a Roth IRA. Now, the traditional IRA operates like this. You put in what we call pre-tax dollars, which means that you get a deduction for putting money into a traditional IRA. Once that IRA grows over time, all of this appreciation will become taxable to you. Now, it's not going to be taxed until retirement, but it will be taxed to you at some point. The Roth IRA is exactly the opposite. You don't get a deduction for putting the money in, and therefore you use what we call post-tax dollars. But the trick is, or the key is rather, that all appreciation grows tax-free. That's a very powerful tool in retirement. Now, why am I talking about this now? Because the market's down and your IRA has lost some value. So let's explain what happens. So imagine that this is your traditional IRA and the stock market at this level. Okay? The market has taken your traditional IRA down to about here. Okay. Now, if we leave your money in a traditional IRA, it's going to appreciate, hopefully to the same level at some point, and all this appreciation will eventually get taxed. There might be retirement, but it will get taxed. But what if instead we took this traditional IRA value and converted it over to a Roth IRA? Inside a Roth IRA, it will go back up just like the traditional IRA would, but this appreciation escapes taxation entirely. So that's, again, like I said, a very powerful tool in retirement. So why is not everybody doing it? Well, there is sort of a kicker to this, and that is that when you convert your traditional IRA money into a Roth IRA, it becomes a taxable event. And so however much you convert is going to be considered ordinary income for tax purposes, and you will have to pay some tax on it. So if you convert $25,000 from a traditional IRA to a Roth IRA, all $25,000 becomes ordinary income. So the tax that you pay, the appreciation, the possible appreciation over time will almost always outweigh the tax that you're going to pay today. But that's ultimately why not everybody can afford to do it. So it's not for everybody, I get that. But if you can do it, I do recommend, especially at this time because the market is low, this is a great time to take that opportunity. If you want to talk about this or have any questions about this, feel free rather to call out anytime at 978-984-5425. Thanks.